Andrew Holland also joins us, Chief Executive Officer with Ambit Investment Advisors. Andrew, good morning. Thank you for joining us. Andrew, you're wearing a red tie, I'm wearing a red tie, but markets clearly are in no mood to correct.
Yeah, I mean, I think, we're all happy that the debt ceiling has not become a problem, and I think the expectations are now that, you could well get a, kind of a year-end rally on the back of, tapering being even further delayed from January of next year till maybe March, April. That will keep liquidity in the system. And of course, with the local elections coming up, Modi fever might take us all to new highs. So I think that's what the markets are thinking at the moment. I can't say that the results season so far has excited me so much. And if you look at if the best companies are, excluding IT that is, the best companies in banking are already showing signs of stress, then I just wonder what the rest of the banking industry is going to show us.
What happens now post the US debt deal then, Andrew? I mean, are we going to see a significant move of liquidity towards the developed markets?
Yeah, I'm not so sure, because I think when you have the debt ceiling to be re-examined again in February, then I just wonder if you might see some slower growth coming through in the US, because we just moved the needle, moved the problem to February. So I'd have to watch the data from the US. It does worry me that you could start to see a slower US going forward, which I don't think will be great for obviously the global economy and therefore markets. So I think it's just something to watch. But I think within India, we have our own events which might overshadow some of the global events which will come out over the next few months. So I'm kind of more negative on kicking the can down the road than I am kind of positive, because I just feel that we have to go through the same issues again in February. The good news is that tapering will probably be off the table till after March earliest of March of next year. But I'm not sure what it means for the dollar. I could see that treasuries could get stronger. You could get flows back into the US because of that in the very short term, and we could see bond yields coming down. So I think the rupee might be under a bit of pressure as well in the next month or so.
Andrew, of late in the fight between macro and liquidity has trumped all fundamental arguments. So do you think the right thing in this market is to focus on liquidity? Because India is a fund flow dependent market, and whichever way the money needle will swing, we pretty much will move in line with that line?
Absolutely. I mean, I think India's been given the opportunity to get its house in order, at least now till February, because after tapering happens, then if we haven't got our house in order, then we go back to the same problems we saw between May and August of this year. So that's the good news for India. But global events are obviously going to be switching around quite quickly over the next few months. But I think my genuine feel is that the risk on trade for emerging markets is probably there now for the end of the year. But the first quarter, because of talk about tapering or when it will happen, and the debt ceiling problems arising, that it could be a kind of a tricky first quarter. Actually, it could be a very painful first quarter for markets globally. So maybe we've got an early Christmas present and we can go on spending, but at some point we're going to have to rein in that spending and pay our debts.
What's the sense that you're getting about the Nifty though, Andrew? Because we're getting increasingly range bound. Sure enough, we made a good dash up until the 60-100 mark, but it seems like the market is hitting some kind of a ceiling there.
Yeah, I think that here's the problem is that, we've been very defensive in our thinking in terms of which sectors we wanted to be invested in, and IT I can still make a case for investing, but mainly below the large three IT companies in terms of the mid-cap companies, and Tech Mahindra has been one of those over the past year or so. But I find it very difficult to now start buying the consumer sector because at 40 times or 30 to 40 times 1 year forward, it doesn't leave a lot of room for any problems in that sector, which we're hearing more and more that there are. And in the pharma sector, the FDA there is kind of after a few companies, and I just wonder whether it's a broader kind of regulation that will hit the pharma industry in India. So, I struggle to buy those three sectors at the moment, so then I have to look at the broader market, and unfortunately the GDP growth and inflation is really not helping any of those companies. I think it's a 2014 story. I'm getting more constructive towards 2014 and feel that these sectors could be the ones to, i.e. the kind of more cyclical sectors could be where we need to start switching. It's a little bit early yet, but we're starting to look at those companies.
Andrew, but IT stocks have been marked outperformers for this year. HCL Tech is up 90%, TCS is up 70%, Infosys has appreciated by 40% plus. So where is the margin of safety? I'm with you when you make a constructive case for IT, but are markets factoring in all the good news?
No, as I said, apart from the top three, I'm looking more at the IT companies below the Infosys and the TCSs and the HCL Tech. So Tech Mahindra, for example, is still trading on a P of 11 and 12, and we still think that re-rating will continue. Similar case for a Mindtree. So those are the IT sectors we're looking at, as I said, I can't make a case so convincingly for IT, but at least they are in areas where you can see growth globally. So unlike pharma and consumer stocks, which are reliant also on the domestic India. So I'm a little bit more wary of those sectors. But just to flesh this out a little bit more for you, Nikunj, is that sometime in 2014, we do believe India will get back on a growth trajectory in terms of GDP, and that will be the beneficiaries of that will be utilities, industrials, autos, and material stocks. And this is where we're starting to put down some of our markers. At the moment, we're looking at companies where we can see operational gearing being a big positive for top-line growth. And when you get operational gearing, top-line growth falls through to your bottom line. And these are companies who are export-oriented as well towards the US and Europe. And if you get financial gearing as interest rates fall during 2014, middle of 2014 onwards, you'll start to see very, very strong earnings growth. So Barrett Forge would fit into that category, and it's a company we've been looking at and investing in more recently.
Andrew, what's the sense that you're getting about banks in particular, the mid-cap boys? Because you did see a flurry of activity in terms of an upside on Monday's session post Raghuram Rajan's comments, and anticipation that perhaps we may see heightened M&A activity in the small-cap sized banks, but doesn't seem to be all that long-lasting. Again, the rally has fizzled out.
Yeah, I mean, you're going to get these types of rallies, and but the question is, for any bank overseas, one, they've been pulling capital back because of Basel III and other regulatory problems that they have in their own countries. So I don't see any of these banks rushing to India and starting to snap up any of the private banks. I think it's wishful thinking on the market's behalf. I think we'll go back to fundamentals, and unfortunately the fundamentals for most of these banks, including PSU banks, are very, very poor. So unless the RBI really wants to have someone taken over because of problems, I really don't see this happening. I mean, the promoters of the leaders of each of these banks, privately have said, they have no intention of selling to anybody. So I think it's mainly more for in terms of trying to realign the banking sector and bring foreign banks, into India, going forward, rather than, trying to say you have to take over these banks. So I think wishful thinking was probably what happened on Monday.
But Andrew, some would argue that all the core concerns for banks are already in the price. The fact that NPAs will go up and margins will come down, that's yesterday's story. That is certainly not tomorrow's trend.
I wish it was yesterday's story, Nikunj, because, all the problems that have been swept under the carpet, I don't think we know the full extent of them all. If you speak to any good corporate in his sector, he'll tell you where the problems are and where the banks are hiding those problems. I don't think it's yesterday's story at all. I think it's if interest rates do rise at the end of October, there's another stress, to be put on the banking sector. There's so many sectors in underpaying out there that the banking sector is reeling under that. So I don't think the worst is over for the banking sector at all. I think it's really just beginning.
Andrew, good chatting with you. Appreciate you taking the time out and joining us today on the show.